I'm Ed Rigby, and I'm a tax strategist with the Kirchen Group. My firm specializes in working with privately owned companies. The past year, the Tax Cuts and Jobs Act brought in a number of new law changes in the past tax filing season for 2018 and going forward. Although many of these provisions in the tax code were taxpayer friendly, we saw a reduction in the corporate tax rate down to 21%, as well as a reduction in the individual tax rates. And for businesses, there was specialized expensing under Section 179 and bonus depreciation, which allowed businesses to write off in the current tax year much of their capital investment for business property. However, when things are favorable for the taxpayer, there's also a number of what's called revenue raisers. In other words, these are disallowance of deductions or limitations on deductions. And one of the limitations is the interest expense limitation rules under Code Section 163J, which kicked in 2018. This interest expense limitation applies to most business taxpayers. There's exceptions for small businesses, which I'll speak about in a moment, as well as real estate businesses, which can elect out of these rules with a toll charge that it affects their depreciation deductions, and also for auto dealerships that have what's called floor plan financing, they're accepted from these rules. So 163J says that the business interest expense is limited to 30% of the taxpayer's adjusted taxable income. Up through 2022, adjusted taxable income does not, in other words, you add back the interest expense, depreciation, and amortization deductions, so it's sort of on a earnings before interest, taxes, and depreciation. To the extent that the interest expense exceeds that 30% amount, the taxpayer doesn't lose the deduction, but rather it carries over into subsequent years. The IRS put out recent proposed regulations which deals with, in particular, partnerships and S corporations. So the limitation applies at the entity level, so at the partnership or S corporation level. Any excess business interest expense that can't be deducted will then pass through to the shareholder at the S corporation or the partner in the partnership. There's also definition of interest expense, and one of the more controversial areas is that the IRS considers guaranteed payments for the use of capital to be interest expense, and that's kind of has a lot of practitioners looking at partnership operating agreements to be careful when they speak about guaranteed payments. Now, there's a small business exception, and that small business exception is tied to the rules which would allow a C corporation to continue to use the cash method of accounting. This is a $25 million gross receipts test. It used to be $5 million, and a new tax law raised that amount to $25 million. However, there's a peculiar rule with the small business exception. So if you're under $25 million, and if you're a partnership or an S corp or a C corporation, you can, in effect, you're out of the interest expense limitation rules. However, the IRS says that if you're a tax shelter, then you can't rely on the small business exception. Now, what's a tax shelter? According to the IRS, a tax shelter includes what's called a syndicate. And a syndicate means that it would include if you're a limited partnership and that partnership is allocating more than 30% of its losses to limited partners, the IRS considers you to be a tax shelter and you can't rely on the small business exception. So that's a particular tricky rule that we're dealing with. Now, for small business, for real estate businesses, now that would be someone that's doing construction, rental real estate, property management, sale of real estate. So it's a broad range of businesses, and you would look to the passive activity loss rules for the definition of a real estate trader business. Now, a real estate business can elect out of the interest expense limitation rules. The toll charge of that is that it affects their depreciation. The taxpayer that elects out of the interest expense limitation rules now has to adopt what's called the alternative depreciation system, or ADS. ADS would apply for, let's say, a taxpayer had business operations up in Canada. If you have foreign assets, you have to use the alternative depreciation instead of the maker's depreciation rules. So for residential rental property, instead of using 27 and a half years, you have to use 30 years if the property is placed in service in 2018. If the property was placed in service in tax years before 2018, you have to use 40 years straight line. If it's a non-residential rental property or non-residential business property, the taxpayer would currently use 39 years straight line maker's depreciation, but then would have to shift it to 40 years. Now, the IRS recently ruled that if you're required to change your depreciation life, it's not considered to be a tax accounting method. Rather, it's, according to the IRS, it's a change in use, which means that if the taxpayer enjoyed the benefits of bonus depreciation in prior years, that bonus depreciation does not need to be recaptured. However, if you're a residential rental property that was placed in service before 2018, you have to use 40 years. As a change in use, you continue to depreciate the property, but over the remaining useful lives of that property. So say you're 3 years in on 40-year property, you would depreciate it over the remaining 37 years. So the interest expense limitation rules are highly complex. We deal with this, with our clients that are not eligible for small business exception, or their real estate businesses, bigger partnerships and S corporations, and again, adopting the guidance that the IRS put out in the proposed regulations is what we do as tax advisors. Thank you.